This week we're going to look at the Australian retailing sector and the equity market and look at some of the key drivers of the sector. Now, it's been a lot of pessimism around regarding the retailing sector here, and we know that it's been down 19% year to date, whereas the market has basically been flat. What I'm showing here is just the comparison of Australian retailing compared to global retailing, net returns for both of them. This is in US dollars, the red. You can see that they had followed each other reasonably well up until about the mid to latter part of 2016. And since that time, Australian retailers have underperformed global retailers by the tune of around about 30%. So there's been a significant divergence. So we want to now have a look at some of the potential drivers of that very poor performance this year. One of the reasons put forward for the poor performance of the retailers has been the threat of Amazon and online retailing. And looking at here, this is just the daily performance chart of Amazon in the pink on the right-hand scale. And on the left-hand scale, we've got the Australian retail sector relative to the overall market. So we can see there the divergence that has occurred certainly over the past 12 or so months, quite a significant divergence. If we look at the correlation between the two, we can see how that correlation has gone from a broadly positive, these are rolling 250-day periods, so a broadly positive correlation to a significant negative correlation over the past 250 days. So perhaps this is and has been a factor, although as we just saw, perhaps less of a factor on a global scale. So let's investigate some of the macro variables that may be impacting the retailing sector. So we'll go through a couple of these slowly. So the first one I want to look at is the relationship between the retailing sector, again, relative to the overall market. That's the blue line on the left-hand scale. So they've underperformed by about 20% over the past 6 months. The red line in this instance is the change in the consumer sentiment series. So they've had a reasonable correlation. Obviously, they're both fairly volatile series, but there has been a reasonably tight correlation over a period of time. And yes, consumer sentiment has been weak, although it's probably been steady more than anything else, yet the retailers have underperformed quite significantly relative to the deterioration that we've seen in consumer sentiment. So that may not be the whole reason for the underperformance. What about actual just retail sales? So if we have a look at the relationship now between the retailers relative to the market, again, blue line, left-hand scale, 6-month underperformance, 20% or so, and looking at what we term cyclical versus defensive or staple retail sales. So that's the more cyclical or discretionary components compared to, say, food sales. And yes, discretionary sales have been weak, but perhaps not as weak as perhaps being indicated by the performance of the retail sector. The next one would be to look at cash rates. And in this particular chart, we are looking at the performance, once again, of the retailers relative to the market. Now, that's just expressed as a ratio. So red line rising, that's an outperformance of the retailers. Now, two other items on that chart is the cash rate. That's the blue line, and we've shaded the areas where cash rates are declining. So certainly what we've seen in recent times is when cash rates are being cut, we're in an easing period, the retailers have generally done quite well, as we saw here in 15-16. Again, during this period, certainly coming out of the GFC and also back in 2001. Probably not so much. Oh, you said eventually it did occur during 1997. So I guess in this situation, as soon as it was become evident that there were no more cash rates in the offering, then the retailers have fallen away, and that's generally been the pattern over recent years. So they've been very much dependent on monetary policy support, and the base case would be at this stage that there is that's unlikely to be forthcoming. But by the same token, there's very little expectation of a rate rise anytime soon. Another macro driver, of course, is the relationship between, say, the NAB retail business conditions and the overall NAB business conditions index. So I've compared those and smoothed them a 3-month moving average. So just to reiterate, the red line is retail business conditions versus total business conditions, and you can see here that it's quite a low level, the red line being on the right-hand scale, so it's quite significantly weaker than overall business conditions, which have been rising to fairly high levels. So yes, the retailers is the blue line relative to the market. They've fallen in response to that, although with somewhat of a lag. In fact, the NAB survey industry components was suggesting a more negative reading a lot earlier. What is interesting, though, there is some evidence that relative deterioration in the retailing sector has come to a close, at least for now. Finally, just in terms of valuations on the retailers, just using a forward PE, and we can see there the blue line, that's a PE rel, so it's about a 30% discount. This is the MSCI Australian retailing sector, so it's relatively cheap compared to the market. The overall PE certainly below its average, that's in the red line, and the blue line, as I said, about a 30% discount to the broader market. So certainly the retailing sector is factoring in a lot of bad news at the moment, and certainly conditions haven't been good. Retail sales in discretionary areas have been weak. Interest rates haven't been cut for a while and don't look like being cut for a little while yet. Consumer confidence is a bit soggy, but a fair bit is priced in, and there is at least some evidence in some parts of those indicators that we looked at that there might be some sort of stabilization. Thank you. And finally, on one other point, just the discussion around wages growth. As we see, wages growth has been slowing quite considerably over the last 3 or 4 years, and you see the annual wages growth has slowed from around about 3.5, 3.75 in 2012 to around about 1.8, 1.9%. So that has obviously been a key issue for the retailing sector. If we drill down and have a look at where the wage growth is actually occurring, I've just sorted the various industry sectors from the highest to the lowest, and we can see that the highest rate of wages growth over the past 12 months to March 17 was surprisingly in the healthcare social assistance area, 2.3, but you can see there the range of outcomes: education and training, public admin, accommodation, food, all of these up around about 2.2, 2.3, finance and insurance 2.2, retail trade down here at 1.8, and the mining sector at 0.63. Perhaps one way of looking at all these is to compare these wage growth numbers to where they were, say, 3 or 4 years ago. So in this chart, the blue line in the inner part of this radar chart represents the most recent wage growth figures, and the sectors are mentioned on the outside, and then the pink line shows where they were back at the end of 2011. So what we see there quite clearly, for example, is in the mining sector, wages growth has slowed from around about 3.5% to around about 0.5%. That's been probably the biggest decline. Other big declines have occurred in the professional and scientific area, from sort of 4.5, 5 into quite low numbers below 2% by the looks of that. So you can see that pretty much across all sectors we've had a decline. One of the sectors to suffer the least decline would be in the actual healthcare sector, where wages growth was already quite low at around about 2.5, 3, and that slowed back to 2.3. But as I said, 2.3% is currently the most rapid wage growth we're seeing on an industry basis. Thank you.